Welcome to the deep dive. If you're like most people, when you hear childcare, you probably think of a few things. An essential service, for sure. Maybe a budget killer.
Or a 4-year waiting list.
Exactly. But today, we are going to change that frame entirely. We're diving into early education real estate as a commercial asset class. And, well, it's currently one of the hottest investment plays in the country.
It's a huge shift in perception. I mean, the investment world, especially institutional capital, has stopped viewing childcare as just a service sector.
They see it as infrastructure now.
Absolutely essential infrastructure. Think power grids or highways. But right now, it's infrastructure that is fundamentally broken because of a massive undersupply.
And the numbers back that up with, frankly, astounding clarity. So this deep dive is based on recent analysis. It's dated December 3, 2025, and it has a really sharp focus on the central Indiana market.
Right. And our mission here is to dissect why this real estate class is being labeled recession-resistant and, maybe more importantly, why one particular market, Indianapolis, is rapidly becoming, well, ground zero for this investment boom.
So let's start with the scale of this. How big is this market nationally?
It's already huge. We're talking $65.15 billion today.
And it's not just big, it's exploding. Right?
Yeah.
Projections show it surging to nearly $110 billion.
Yes, $109.88 billion by 2033. That's a compound annual growth rate of 6.02%. It's a highly predictable growth curve built on, well, necessity.
And here's the number that really stopped me, the core reason for all of this.
The raw supply constraint. It's the whole story. We have 14.7 million children under the age of 6 who need care.
Okay.
But we only have 8.7 million licensed spots available anywhere in the country.
That is a staggering 6 million spot shortfall nationally. So you aren't investing in some discretionary service. You're investing in bridging a critical infrastructure gap.
Which means the underlying demand is almost perfectly inelastic. When you have a deficit of 6 million slots, the demand floor just can't fall out. It's a guaranteed long-term need.
Okay, let's unpack that guarantee. Segment 1, the national surge and this whole recession resistance thesis. What's accelerating demand right now beyond just population growth?
The biggest driver is the labor force. I mean, the necessity of dual-income households plus all these return-to-office mandates. It's pushed maternal workforce participation for mothers with kids under 6 to an astonishing 76%. If that workforce has to be at the office, they must have licensed care. That requirement doesn't go away if the economy slows down.
The demand is non-negotiable. So let's talk about the reality of the scarcity. The analysis uses this really powerful term, the childcare desert.
It sounds dramatic, but it's a quantified term.
Yeah.
Over 51% of U.S. communities actually qualify as childcare desert.
What did that mean exactly? A 3-to-1 ratio.
At least 3-to-1. Demand outstrips the licensed supply by at least that much. It's an acute crisis in these places.
And you see the immediate fallout in the wait list.
Exactly. The average wait time is 6 months, but what's really alarming is that 13% of families are waiting a full year, sometimes longer.
So let's connect that back to the investment thesis.
If a center opens in one of these deserts, it is guaranteed 100% enrollment capacity. Instantly. That just completely eliminates vacancy risk for the operator.
That's the missing link. An operator with zero vacancy risk is a golden tenant. But I have to ask the skeptical question. Recession-resistant is a strong claim. Why do parents cut this expense last? It's so expensive.
Because it's the linchpin. It's what allows them to generate their income. If they cut childcare, they have to cut their jobs, and that's a far more catastrophic financial decision.
And we have evidence of this.
Oh, yeah, empirical evidence. Enrollment in early education actually grew through both the 2008 financial crisis and the 2020 pandemic. It's counter-cyclical.
That kind of stability must look incredibly attractive to big money.
It does. When institutional funds, REITs, big family offices are looking for assets that can deliver predictable returns no matter what the economy is doing, they call this sector bond-like. It has bond-like stability.
And that stability is structurally baked into the real estate deal itself.
That's right. These properties are typically sold with the operator already in place under a long-term triple net lease.
How long are we talking?
We're talking 10, even 20 years. And crucially, they usually come with corporate guarantees from major national operators. You know, your Primrose, KinderCare, Bright Horizons.
Okay, for anyone new to commercial real estate, just remind us what triple net means and why it's such a massive factor here.
Right, yeah. So triple net, or NNN, it basically means the tenant, the childcare operator, pays for virtually all the operating expenses.
Property taxes, insurance.
All of it. Maintenance, too. The landlord simply receives a monthly check. It creates the cleanest, most passive form of real estate ownership you can find.
And on top of that, you get your hedge against inflation built right in.
Precisely. The leases have mandatory inflation hedging escalators, usually 2 to 3% annual bumps. This ensures your cash flow isn't just predictable, it actually increases every single year.
Okay, let's pivot. We get the enormous national need. But why Indianapolis? This is where it gets really interesting for me. Why is central Indiana being called ground zero for this boom?
It's a perfect storm. It's created by this hyper-localized acute shortage combined with some really unique, substantial cost advantages. Let's look at the Indiana specifics first. The state is only meeting less than 2/3 of its total childcare need.
And we can put some hard numbers on that local deficit.
Absolutely. Indiana has roughly 850,000 children under the age of 5, but they are served by only 763 licensed centers.
Wow.
That's an enormous gap, and that deficit has a direct, measurable drain on the regional economy. The analysis details a stunning figure here.
I saw this. It's shocking.
Inadequate childcare access costs Indiana $4.22 billion annually. That's lost worker productivity, lost wages because parents can't work, and of course forfeited tax revenue.
So when the impact is measured in the billions, solving the problem becomes an urgent, government-backed infrastructure initiative.
Exactly. Solving the social crisis becomes a mandate for economic growth. And that mandate is targeting the very areas where the state is already growing fastest, those logistics and life science corridors.
Can you give us some examples of that growth colliding with the shortage?
For sure. Look at Hamilton County. Since 2020, they've added about 4,000 children under age 5. At the same time, places like Plainfield and Whitestown, the heart of the logistics boom, have added over 40 new distribution centers since 2021.
And those facilities employ thousands of people.
Thousands of people who need care right now. And we can pinpoint the worst of these child care deserts, the 3-to-1 zones. We're talking Western Hendricks County, Northeast Johnson County, and the entire Boone County growth corridor. These are prime investment targets.
So the local need is acute. Now, the investment edge. Why are investors choosing Indianapolis over, say, Austin or Raleigh or Phoenix?
It really boils down to two things: entry costs and superior cap rates. Developing a child care center requires specialized land, right? At least an acre, specific zoning for play areas. In central Indiana, in those growth corridors, entitled Land Still Trades for just $12 to $18 per square foot.
And how does that compare to those other Sunbelt metros?
It's not even a contest. That is 3, sometimes 4 times cheaper. In Austin, you'd be paying $50, maybe more, per square foot for comparable land. That difference just completely changes the development math.
It makes new construction actually pencil out.
It pencils out profitably, and the returns reflect that. The triple net childcare cap rates in central Indiana are hanging high, between 6.5 and 7.5%.
And that's the critical piece.
It is. Those rates are 100 to 200 basis points higher than what you would get in a coastal market or a Kentucky Sunbelt market.
So for our listeners, a basis point is 1/100%. So we're talking a full 1 to 2 percentage points higher return on your cash flow from day one.
Exactly. Superior cash flow, bond-like stability. Plus, Indiana is actively making the deal even sweeter with financial incentives.
The government assistance layer. The analysis highlights the employer child care expenditure credit.
It's powerful. That credit reimburses employers up to 50% of their initial setup costs, and it's been extended through July 2027. Developers are also using IEDC grants and TIF districts in those high-growth counties.
So that added leverage, the lower land cost, the state incentives,
Yeah.
it all just makes the economics undeniable.
It can easily add 1 or 2 points to the long-term IRR for a project. Makes an already compelling investment look exceptional.
Okay, let's move to the strategies that are actually working on the ground. The analysis details 4 core approaches.
Right. The first and most straightforward is strategy 1. Triple net lease acquisitions. This is what the big institutional funds do. They buy an existing stable center that's already leased to a major national operator.
This is the passive play. Own the property, hold the long-term lease, collect the check.
Yep. Strategy 2 is becoming really vital in markets like Indianapolis. Sale leasebacks. This targets established local owners, people who have run a successful business for 20, 30 years and own the building outright.
And why are they looking to sell and lease back?
They have millions locked up in real estate equity. A sale leaseback lets them unlock that capital tax-free if it's structured right to fund expansion, or maybe just to fund their retirement. And the leases you get are some of the cleanest in commercial real estate.
Right.
The seller knows that property inside and out.
That makes perfect sense. Okay, what about the speed problem? Strategy 3, adaptive reuse.
This is super efficient, much faster than new construction. Adaptive reuse focuses on repurposing large, empty spaces. Think vacant big box retail
Which you
stores.
see a lot of.
A lot of them.
Oh,
Or second-generation office space that's now sitting empty. We're talking about a footprint of 25,000 to 40,000 square feet, often along major highways like I-465 or I-69. You can turn these into licensed campuses for 250 to 400 kids in just 12 to 18 months.
and finally, the most capital-intensive approach, but potentially the highest returning. Strategy 4, ground-up development.
This is targeting that raw land in those growth corridors we mentioned. Whitestown, Lebanon, Bargersville. Because the land is still relatively cheap, these ground-up sites are modeled to deliver a strong 11 to 15% IRR over a 10-year hold.
So speaking of returns, let's talk about the metrics. If you're coming from residential investing, you're used to talking about cap rate. But the sources are insistent that the internal rate of return, the IRR, is the only metric that really matters here.
It's an essential shift in how you think. The cap rate is. It's a snapshot. It tells you the simple cash yield on your investment today, year one. The IRR, on the other hand, tells you the full movie of the investment.
The full movie being everything that happens after year one.
Exactly. The IRR counts for every single cash flow over the entire hold period. The annual rent escalations that compound, the debt paydown, and the final sale price at the end.
Let's illustrate that. Why are those small, say, 3% annual rent bumps so powerful over the decade?
It just transforms the math. You might see a new center, and it's a modest 7 cap on paper. Okay. But you model that 7 cap property with guaranteed 3% annual escalators, compounding for 15 years.
The rent isn't just going up 3% of the first year's rent. It's 3% of the previous year's rent.
Precisely. That compounding effect, plus the stability of the triple net structure, means that property routinely delivers a mid-teens IRR. We're seeing 13 to 16% modeled routinely. That is a serious return for an asset class we're calling bond-like.
The analysis gave a specific real-world example, a $6.2 million Indianapolis area childcare investment projected to yield a 13.8% IRR. That kind of predictability must let institutional investors borrow cheaply against it too.
The reliability is key. You know the demand will be there, you know the tenant is locked in, and you know the rent is going up 3% next year. It reduces the modeling uncertainty to almost zero.
And for those of you who manage, say, single-family homes or small apartment buildings, the analysis calls this one of the smoothest transitions into professional commercial real estate. Why is that?
Because you already get the fundamentals. You understand location, demographics, growth corridors. You already know what a good area looks like.
The difference is just in the management and the tenant.
Yes. You trade all the headaches of residential tenants, late rents, maintenance calls, turnover for predictable, passive, triple net cash flow backed by a corporate guarantee. You go from being a hands-on manager to a passive investor in an essential business. It's an exponential upgrade in predictability.
This has been a fascinating deep dive into how a major social crisis is generating a premier real estate investment opportunity, particularly in a market like central Indiana.
The key takeaways are pretty straightforward. First, that enormous 6 million spot national supply gap. It provides an investment floor that is truly recession-resistant. And second, Indianapolis offers this perfect arbitrage opportunity. You've got acute local demand paired with cost efficiencies that drive cap rates to that 6.5 to 7.5% range.
A range that is just unattainable in high-cost coastal metros.
For sure. But that window of opportunity in Indiana, it's narrow. How quickly is that 100 to 200 basis point advantage going to disappear?
That's the question.
It's closing rapidly. Institutional funds are raising 9-figure pools specifically to deploy into this exact asset class. I mean, we saw in Q3 2025 that while national property listings rose 14%, cap rates only budged 10 basis points. That's a clear signal that demand is just absorbing supply instantly.
So once Indiana cap rates compress another 100 basis points,
Those high-yield entry opportunities for new investors will be gone.
a truly compelling case for urgency. If you consider that massive $4.22 billion annual economic loss in Indiana alone, the cost of doing nothing, it forces a final provocative question for you to mull over. If filling the 6 million spot national childcare shortfall is both an essential economic stabilization measure and a robust, predictable investment, what other critical, currently undervalued societal crises related to essential infrastructure are waiting to be recognized as the next high-yield commercial real estate opportunity? The next deep dive begins with the answer.